Cool, there we go. So I wanted to get on today to talk a little bit about down payment assistance programs and just kind of the overall lending market in general. The three main things that any lender is going to look at when it comes to lending are income, credit, and down payment funds, cash to close funds, right? And so when we get an application from you guys or get a lead that comes in, those are the things that we're going to look at to be able to make sure that we have a really solid pre-approval, pre-qualified buyer that goes out and shops with you guys. If any of those three things essentially isn't in line with what they need, for example, if a borrower has decent credit, they have decent income, but they've only got $1,000 in their savings account, then we can at least structure a deal and let them know, hey, based on your current income, based on your debts and liabilities, your credit, here's what you would qualify for, and here's the minimum amount of costs you would need for the down payment. If we were using in that scenario, it would be a down payment assistance program, or vice versa. If they have a decent amount of down payment, decent credit, but their income isn't quite there yet, we can maybe throw out alternative options of maybe getting a co-signer or letting them know where their income would need to be at to be able to qualify for the price range that they're hoping for. So those are the three main things when looking at, applications, looking at qualifications: cash, credit, income, and we go from there. One of the programs that we have used actually quite a lot with home buyer realty clients is our open door down payment assistance program. Now, one thing about this program and another that we use called CalHFA, what's happened recently with the rise in interest rates are these programs are there's less and less help essentially, especially over the last 2 weeks. So I do want to make that clear as far as the assistance and how much is available to help these folks with their down payment. What they tend to sacrifice with these programs is a higher interest rate to be able to come up with less funds at closing. But back to our open door program, the reason why this one has been so successful is because there's a lot less on the credit qualifying point. You only need a 620 credit score to qualify. So a lot of first-time buyers, maybe they don't have their credit in line. It really is lenient on the credit score side. And then as far as debt to income ratio, most down payment assistance programs, you need to have a 45% debt ratio or less to be able to qualify. This program actually does not have a debt ratio limit. So we can a lot of times stretch their purchase price is as high as they can go, which, as we all know, in most of these scenarios, we want to try and get these folks into homes, and prices are, a little up there right now. And another good thing about this program is that essentially, whatever the DU approval gives us, that's what we can run with. So there isn't a bunch of layered guidelines on top of it. If we can get a Fannie Mae approval through the automated system, as long as they have that 620 credit score and enough cash to close to cover the difference after the assistance, they're good to go. So and also there is no income limit for this particular FHA program. So it's something that we've utilized a lot. It gives folks a lot more range and a lot more options when it comes to their purchase power. And it's something that's been pretty successful over the last, I think, 2 years. We've really been running with it and used a lot with our home buyers clients. So it's worked really well. The second option, which is a little more stringent, I guess you could say, as far as underwriting guidelines, is CalHFA. And I can show you their website really quick just to kind of give you an idea of what this looks like here. One second. You guys have access to this. Anyone has access to this. You can just go to calhfa.com and pull up their interest rate. So as you can see, these rates are starting to climb. On an FHA loan, if we were doing FHA for a first-time buyer, they'd be looking at, if they were getting the max amount of assistance, which is 3% of their sales price, they'd be at a 6.25% right now. And this program actually limits their debt ratio at 45%. So, this is a tough one to get someone qualified for, just for the fact that the interest rate's so high and the fact that they're limited to a 45% debt ratio, whereas open door program, we can usually get it up to 54 to 55%, which in most cases, obviously, we're going to talk with clients, make sure that we're giving them an approval that also fits their budget. So one of the first things I ask someone when they're looking to get pre-approved is, what's your absolute max monthly payment that you feel comfortable with? And sometimes we reverse engineer a loan around that and let them know, hey, if you say your max payment's $2,500, well, then that would result in, $425,000 purchase price, or whatever the case may be. And then from there, they can start shopping and figuring out what they need to do. If they need to push that a little bit higher because the homes that they're seeing are at 450, then we'll make those adjustments and let them know what that payment would be. But essentially, these are the two main programs that we use whenever someone doesn't have the necessary funds for a standard loan, which FHA is 3.5%. Conventional, you can actually go 3% down if you have good enough credit. But first-time home buyers usually need a little bit of help, a little bit of assistance. And so these are some of the programs that we run with them. Now, another thing to mention is you can also get gifted funds from family while using these down payment assistance programs. So those are some of the scenarios where someone literally comes in with maybe $1,000 out of their own pocket if they're getting an assistance program and also getting help from a family member that's covering a little bit of the leftover closing costs. At this point, if you guys are out and talking with buyers, I mean, you don't need to know all the intricacies, I would say, of some of these programs, but just having some of that basic knowledge and knowing the names of some of these programs and how they work to a limited degree, I think will help you guys just exude some confidence in knowing that the programs that are available for some of these first-time homebuyer programs. Let's see here. Let me stop sharing this one. Did anyone have any questions about this program or things to look for? Ron, do you have any questions?
Yeah. Can I do a little role playing with you?
Yeah, sure.
All right. Pretend I'm the buyer. I'll just call you.
All right, ring, ring. This is Josh Hollman at Summit Funding. How you doing?
I'm doing great. Hey, I want to buy my first home. I have good income, but I don't have any money for down payment. What programs are available to me?
Well, sure. Let me take a look. First, let me ask you, what's your time frame?
As soon as possible, because interest rates are going up.
Interest rates are going up. Are you currently renting or living with family?
Renting.
Okay. What's your current monthly rent you're paying right now?
Roughly $1,800.
Okay. Is it just yourself? You have any kids, wife, spouse?
A family, yeah.
Family?
Kid. Yeah, wife, 2 kids.
Okay. What are their ages?
Oh, 7 and 10.
Okay, cool. So they're in school, elementary school, right?
Yep.
Okay, right on. And before we start getting into any specifics about programs, just what is one of your major concerns or worries about jumping in? You're a first-time buyer, right? What's one of your major concerns or worries about getting into a home or starting this process?
Just getting into a home, because I know everything's going so fast and rents are going up.
So just the timing of it. You don't want to have to pay a higher payment. So would you say you're more payment conscious than anything else?
I'm saying I'm probably more, I want to own a home conscious than anything else. I don't want to be a lifelong renter.
Start building that equity. I got you. So how much money are we working with as far as savings?
Probably $3,000 or $4,000, whatever I get back from my landlord.
Okay, perfect. So what we'll do is we'll take a basic questionnaire where we start getting some of your initial information. We'll look at your income, we'll look at your credit, and we'll work with that $3,000. Now, we do have a down payment assistance program, which allows for you to get a grant. It's called our Open Door program. Now, we'll have to see exactly how much of that grant we can get and access to be able to get to that $3,000 limit. We may have to wait a few months to save a little bit more, but what we can do is set up a mortgage planning session where we go over what you qualify for and exactly how much money you'll need to be able to get into a house. Now, one of the things that I really want to make sure though, is that we're putting you in a payment that's comfortable for you and your family. $1,800 a month rent is pretty decent. It's not as low as I've seen, but that's pretty decent. So what would you say your max mortgage payment would be? Perfect house, everything works out. What do you feel like in your budget you would be able to handle?
24 to 25.
Okay. And what real estate agent are you working with?
Someone at Homebuyers.
Is it Ron Cedillo? Ron's great. His team's
Hard to
great.
get that guy out of his house.
They have a great vast knowledge of the market, and they're actually the top mortgage brokerage in the Central Valley. So you're in good hands, and we'll take definitely good care of you. Make sure that we're getting you everything that you need to know. That would be the initial conversation right there, where I don't tend to start throwing out too many numbers until we know their scenario, right? We want to look at their credit, should we look at their credit and they may have a 520 credit score, and then it's just, hey, you got to work on that credit. You got to work on saving a little bit. In most cases, for example, we just closed one of these programs for, I believe it was Yolanda's client, just funded yesterday, actually. And I think they ended up going for a $450,000 purchase price, and they ended up needing to come up with about $13,000.
So quick question.
Total.
Everyone talks about you can't use these down payment assistance programs in today's market because it's so competitive. Myth, truth?
I would say as long as the offer is structured correctly, and I would say strong, we've closed quite a few of them. I mean, it is true that there is a difficulty if there's an appraisal gap coverage that needs to come in, because obviously if these folks don't have an abundance of funds, that's going to be something they struggle with. But honestly, your team's done a great job of structuring the initial offer, whether it's the price that they're offering, the terms. We are able to shorten the escrow periods on some of these loans. We actually process them really quick. So I think one of the common misconceptions about a down payment assistance program is that's going to take a 45-day close or over 30 days. I mean, we've closed these things well under 30 days. As long as we're all moving at a fast pace, we can structure terms a little bit more aggressively on these programs as well.
How are listing agents looking at these kind of offers when they come in?
One of the things I explain to them is that this isn't something that should deter them, because we do get DU approval on them. It's not some deal that we have to broker out or something that has like really wonky guidelines. It's pretty straightforward. It's either an FHA or conventional loan. And as long as we fit under the guidelines that the program is there, we run a DU approval. So it's the same type of loan, the same type of approval if you were doing a standard loan.
Okay. And do you need two appraisals on this?
Nope. One appraisal.
So one appraisal, you can do it within 30 days. Listing agents are obviously accepting them. Do we need any credits back from the seller?
Nope.
Do we need any lender credits?
We do not.
Why would someone not take this type of loan?
If they had a misconception that it was going to be, a longer escrow, or that it just wasn't, a borrower that it was as strong as a standardized loan. But that's one of the things that we try to do when an offer goes in, is I will call that listing agent to kind of reassure them that the communication is going to be there and that we have a great track record with these type of programs.
And who owns these funds? Is this a state of California, a federal, or is this your company's funds?
So what Summit does, we do the first mortgage as a standard loan, as a FHA or conventional loan. It goes straight to them. And then these particular programs, whether it's CalHAFA or GSFA is who does the open loan program, they actually hold the notes to them and service those loans. So it's those particular entities, they're not government backed, they're just kind of a private company that runs these programs. Okay.
And do these funds ever run out of, do you ever run out of funds?
There was a point where, it's possible, yes, where they can stop these programs and say, hey, the market's too volatile right now. We're going to hold back if pricing, is too out of whack. So for example, when the pandemic hit, March, April of 2021, and rates were kind of going crazy for a second, they did put a pause to offering these programs until they could kind of figure out the market volatility a little bit.
If you were in contract with that during that time, were you cut off, or did they honor those? Just didn't bring on new people?
Yeah, they definitely honored the loans that were approved and already in process, but anything after a certain date, they weren't going to take if you didn't have it in the pipeline.
Okay. Who's the ideal client that should be part of this program? Like, who are you looking for? What is that avatar of that person that comes to you? Like, these are the people that definitely are looking for that age group, income group, credit group. What does that person look like?
Yeah, great question. It's usually someone with, in between that 620 to 660 credit score range, because obviously 620 is the kind of minimum. And honestly, it's just someone that doesn't quite have the savings. If they've got the credit and they've got the income, and they maybe got a little bit saved and a 401k they can pull from, or maybe even a family member that could kick them an extra $5,000 to get them there. So really, as long as they got that credit and they got 620 to 660, and are struggling with having, a minimum down payment on a standard loan, that's who we present this to. So it's gotten quite a few folks into homes. And one of the benefits of it, especially the open door program, being that the largest part of the assistance is a grant, they don't have to pay the money back. It's free money that helps them with that, right? So they have a great opportunity for refinances down the road, even if they are taking a slightly above market interest rate to get into the house at less cost.
And how much is the grant typically?
I'm sorry?
How much is the grant typically?
Typically the grant's anywhere from 2.5% to 3% is usually what we will choose. But if they want a lower rate and have enough funds, they don't have to necessarily take the max interest rate. They can go a little bit lower on the rate and receive a little bit less of a grant if they're more payment conscious.
And do they still have PMI on this?
Yeah.
Okay. And will the PMI ever come off if it's a conventional loan?
Yes.
What do they have to do that?
So typically you would need to be at a 20% equity position, which in most cases, we will just look into refinancing them, especially if they were in like an FHA loan at first, and they get a 20% equity position, we'll just look to do a refinance. If they were already in a conventional loan, once you get to 78% loan to value, that MI will naturally come off the loan. So there's actually an amortization schedule where you can show a client that says, hey, look, after this many payments, your balance will naturally put you at a 78% loan to value, a 22% equity position, and that mortgage insurance will naturally come off your loan if you have a really good interest rate. Perfect. And you don't want to refi out of it.
Anybody have any other questions for Josh? Because I want to go in a whole different direction.
Yeah, we're talking PMI.
Okay, so let's go in a whole different directions. I see things from a real estate point of view. I want to hear it from a mortgage point of view. What is your prediction for the end of the year? How many interest rate hikes? What's this recession going to mean? What are you seeing and what are you hearing from a mortgage person's lens?
So I can easily see, and you can see right there on the CalHAPA program, interest rates are already above 6 on some of these down payment assistance programs. So kind of the consensus within the mortgage community is we can easily see interest rates in the mid 6s by the end of the year. And that's with someone with decent credit and a decent down payment, right? Right now, I would say, let's say you're someone with great credit, 20% down, you're probably looking at something mid to high 4s, depending on how much of a buy down you want to use. If you're someone with kind of moderate to average credit, you're looking at something high 4s, low 5s. What that, in our opinion, is going to do to the market, hopefully it'll somewhat help our buyers a little bit where it'll be a little less competitive. I still think we're going to have inventory issues. I don't see a ton of extra inventory coming on the market this year. So if anything, that may help level off prices a little bit where it's not as competitive. You're not having to over offer on a listing price. Maybe you can come in at listing and maybe at some point get back to where you can come in a little under or have just a little more negotiating power. From a real estate perspective, have you guys seen any slowdown in or how many offers you're getting on listings right now with these rising interest rates?
Yeah, we were going from like 20 offers. We're down to like anywhere from 3 to 10.
Right. So a little less competitive, right?
Yeah, absolutely. And we're still getting a little bit above asking. The problem is, like they were really coming like, like I said, 20 offers, and you really could just choose your terms at that point.
Right.
Now there's a little bit more negotiation. This last week, one of the problems we saw was we'd get into contract, and within a couple of days, they'd fall right back out. Like people just weren't aware of their payment structure. Like, oh, my payment's going to be that. Oh, I can't afford that based on today's rates.
That's an absolute great point to touch on. So one of the things that I really, really think needs to happen and should always happen is work really, really closely with your lender. And one of the things that, even if you guys can't get the deal over to us, if you have a buyer that's pre-approved with another lender, really vet that lender. We've gotten a few deals these last couple months where this buyer should not have been out shopping for the price range that they were. We just have one right now that we're trying to save that the lender didn't even know. They had him approved. They were out shopping for a $500,000 house. They didn't even know that the borrower was self-employed. And so then all of a sudden they get into contract and they're like, oh shoot, they don't qualify for this. And so we had to figure out a way to try to save it. So when you're looking at putting in an offer, absolutely call the lender, vet them, right? Look at DU findings and LP findings, have that be sent in, double check the proof of funds, make sure that the buyer knows what the payment's going to be, because if they have an approval from 2.5, 3 weeks ago, it could look a lot different for that price range that they've been out shopping for and looking at. So I would say just at this point, realtor and lender work really, really closely. So every time you go to put that offer in, talk with your lender, make sure that the terms and everything are clear with the buyer for sure, and that they can actually qualify for that price that you're looking to offer for them. Little things that come into play, making sure that the house doesn't have solar that the buyer doesn't know about, right? A solar lease may throw off their debt ratio or may just throw off the payment budget that they have if there's a $200 solar payment they weren't aware of. Melrose tax, if it's a property that has high fire insurance or flood insurance, things like that can make huge differences, especially if within a week an interest rate goes up 0.5% and their payment jumps up $200 just from the market volatility. So at this point, we have to work really, really closely when we're putting these offers in to make sure that these people are truly still qualified for that price and still can handle that payment if it has gone up since their initial approval.
Last question is, when you're working with some of these buyers right now, what are they asking for? What are they looking for? What is it that what is their mindset right now when they're coming to you? Because I know we send you, I don't know, 5 to 10 leads a week. So you get to see a different point than we get to see. Like sometimes we send it to you and we don't always know what that next conversation is. Right. What are they saying to you?
They're saying the same thing that your role play. When I asked them the reasoning for wanting to buy and why now, is they've seen, especially over the last 2 years, prices jump dramatically, right? A lot of them are kicking themselves when they said, oh, I'll wait for the market to crash. When they could have bought a house for $350,000 2 years ago, now that same house is at $450,000, $475,000. So they're wanting to make sure that they can get into the house before prices continue to elevate. And they're seeing these interest rates now rising up and they're feeling a little bit of that urgency. So that's one of the things that you immediately pick up on, is that they do want to move quickly because they're feeling like this is their last chance before who knows what's going to happen over the next year, 2 years. So we do see a lot of urgency, a lot of folks that are conscious of how the market's been moving the last few years. They've seen probably friends and family that have bought, locked in low rates. They've seen their house appreciate. So they're wanting to get in there and get out of this renting environment.
Good stuff. All right. Any other questions, guys? No.
I
All
would
right.
say too, Ron, I know you touched on a potential recession coming. So if that happens and there is maybe some of the forbearance that was happening with COVID, some of these folks, if there's any sort of job issues, employment issues come up, if there are a little bit more inventory that comes out, or if a recession truly does hit, although that's tough on our economy, it is actually a good thing for mortgage rates. Usually when there is a recession, there is going to be some help from the Fed again, where they come in and buy bonds and interest rates come back down. One of the things that have happened is all this inflation, the war, things like that, that have caused this, policies to increase these interest rates. But if there is some recession, that can give us a little bit of, from an interest rate standpoint, a little bit more pullback where we get these rates leveled back down a little bit. So that is kind of a mixed bag. It's a catch-22, it's no one wants to hear recession and maybe lose their job or things of that nature, but it does usually play well for mortgage rates.
Okay, perfect. Thanks a lot, Josh. I appreciate it. You can hit the stop recording button.